If you choose real estate over stocks at 25, you won't just make money differently, you will live a completely different life. You are 25. You have $12,400 in a savings account earning 0.41% annually, which means it's earning $50.84 a year, which means it is earning $4.23 a month, which means it is losing ground to inflation every single day it sits there untouched. You know this. You have known this for a while, and now you are sitting across from two different versions of what happens next. You are about to make one decision, and it will not feel like the most important decision of your life. That is the part no one warns you about. You will think you are just choosing between two reasonable options. You will not think you are choosing a life. Both of you. That's where this splits. You spend 4 months driving neighborhoods on weekends. You develop opinions about school districts you do not have children in. You learn what a cap rate is from a YouTube video at 11:47 p.m. on a Thursday. You learn what deferred maintenance looks like before you learn what it costs. In March, you use $10,800 of that $12,400 as part of a 3.5% FHA down payment on a $214,000 duplex in a mid-sized city where median rent runs $140 per unit per month. You will live in one unit. The tenant in the other will pay $140 toward your mortgage of $1,391. The math works. Barely. But it works. Your name is now on a deed, something that exists at a physical address, something that can be driven past, touched, photographed, or inherited. The first tenant is a woman named Diane, 34, who works in hospital administration, pays on the 2nd of every month without fail. You know her check schedule before you know her last name. In month 3, the water heater fails. It costs $247 to replace. You did not have a system for this yet. You pay it from what remains of your savings and you feel it. But in month 4, Diane pays $1,140. Month 5, month 6, there's a Saturday in November, you are 26, when you sit at the kitchen table of the unit you occupy and run the numbers for the first time since closing. Your mortgage principal has dropped $903 in 11 months. Diane has contributed $12,540 toward a building you own. A comparable sale 2 streets over suggests the property has moved up approximately $7,200 in value. You did not feel any of that happening. That is what surprises you. You are not wealthy. You are not even fully comfortable. But something is being built in a direction that did not require your daily attention. And for the first time, you understand what leverage actually feels like from the inside. Not as a concept, but as a Saturday morning number that is larger than it was without you having done anything that week. That Saturday is the moment. Not because of the equity figure, because of what it means that someone else's rent is accumulating into something with your name on the title. You keep all $12,400. You open a brokerage account on a Tuesday evening, transfer $10,000, and set up an automatic monthly investment of $420 into a total market index fund with an expense ratio of 0.03%. You read 3 books. You understand, with reasonable clarity, what you are doing and why. You are not buying a building. You are buying a fractional claim on the earnings of 3,742 companies simultaneously. You are buying the concept that the American economy will, on average and over time, be worth more in the future than it is today. A colleague named Marcus, 27, has been doing this since he was 23, tells you the only rule is not to sell. You write it down somewhere, you don't frame it. But you don't forget it either. The first year, your $10,000 grows to $11,280 on paper. The $5,400 you've contributed over 12 months brings your total balance to $16,247.09. The market did something. You did not have to replace anything. You did not have to learn what a sump pump is, what a CO detector replacement costs, or what a lease addendum looks like. You also do not have a key to anything. No address, no deed, nothing you can drive past when you need to remember why you started. Some months that absence sits heavier than others. You are not sure yet what to do with that. Gap statement, age 26, path A. Estimated equity of $9,100 in a single leveraged asset at 94.8% LTV, plus an additional $1,047 spent on infrastructure you now own. Path B, liquid portfolio of $16,247.19 across thousands of positions, 0 leverage, 0 maintenance obligations. The distance is 7,147, but the number doesn't tell the real story. One is an address in a specific zip code, illiquid, physical, and requiring a contingency fund for things that break. The other is a number on a screen that can become cash in 3 business days in any city without a single phone call. One carries weight you can feel. The other carries a risk that doesn't make a sound. Both systems are 11 months old. Neither one has been tested by anything real yet. This is where it stops being theoretical. Diane leaves in February, not dramatically. She gets a job offer in Columbus, gives you 30 days notice, and leaves the unit cleaner than she found it. You thank her, you mean it. And then you sit down with the number. $1,140 a month. Gone. Your mortgage is still $391. The math that worked is now math that doesn't. You post the listing on a Thursday. You get 4 inquiries. 2 ghosts, one who wants a month-to-month lease you can't afford to offer. One who needs to move in 6 weeks, not 4. You wait. The mortgage does not wait. Week 3, the roof inspector you hired before purchase sends the follow-up you had been quietly hoping would never arrive. The flat section above the rear unit needs attention within 14 months. Estimated cost, $8,400. Your cash reserve is $2,100. These two numbers sit in your head at the same time, and they do not fit together. That same month, a friend named Ryan, 28, sharp, the kind of person who calls things early, mentions he's pooling capital with 2 others to flip a property in Raleigh. Estimated 4-month turnaround. Projected return, $34,000 split 3 ways. He needs an answer by Friday. You open the calculator. You look at the equity figure, $31,000 on paper. Unreachable without a cash-out refinance that would take 60 days and cost $4,100 in fees. You look at the cash reserve, $2,100. You look at the $8,400 coming. You close the calculator. This is the first time the math doesn't protect you. You tell Ryan you're in a difficult position right now. You don't tell him the position has a name. The name is illiquidity. You didn't fully understand what that word cost until this month. 37 seconds. That's approximately how long you stared at the equity number before closing the tab. You don't know yet if that was discipline or fear. You won't know for years. A new tenant, a man named Joel, 31, IT project manager, moves in at $190 a month. 6 weeks of vacancy, $6,840 in lost rent. The system restarts, but the 6 weeks do not disappear. They become a line item in a mental ledger you didn't know you were keeping. You open a new tab in your spreadsheet. You label it, Emergency Reserve, minimum $11,000. You did not have that tab before February. The building is still yours. The equity is still growing. Something is still being built. But the building now has a cost you can feel in a way the equity figure never quite captures. The market drops 19.3% in 7 weeks. Not gradually, not in a way that gives you time to prepare a philosophy. Tuesday, it is down 4.1%. Thursday, another 3.8%. The following Monday, your portfolio, which was $22,847 11 days ago, is worth $18,247 on a screen that refreshes every 15 seconds if you let it. Marcus calls. Don't look at it. You look at it. Every day. Sometimes twice. This is the part the books don't prepare you for. Not the math of a drawdown, but the specific texture of watching a number that represents real decisions and real hours and real deferred purchases move in the wrong direction with complete indifference to any of that. On day 11, you open the sell interface, not to execute, just to look at it. The button is there. It would take 4 clicks. The money would be in your checking account in 3 business days, and you could do something with it. Something tangible. Something that didn't refresh every 15 seconds. You read 3 articles about sector rotation. You read 1 about tactical asset allocation. You have a tab open on moving averages. You are very close to becoming a different kind of investor. The kind that is always 6 weeks behind the market, always reacting, always certain the next move is the smart one. You don't do it, but you are close enough that not doing it is an active choice, not a passive one. That distinction matters. You will not fully understand why until much later. The auto invest runs at $420 on the 14th of the month. You watch it execute. You feel nothing but confidence. You feel something more like stubbornness dressed up as conviction. You are not certain in that moment which one it actually is. The market recovers over the following 5 months. Your balance reaches $24,103. The $420 you bought at the bottom of that correction will become the most valuable $420 in your portfolio. You will not know this for years. The Raleigh flip closes in 4.5 months. His share, $31,200. You hear about this. Everybody hears about it. Ryan mentions it the way people mention things they know will be heard, casually, in a group, over dinner. What you do not hear about, the 2 other people in Ryan's network who did similar deals that year. One broke even after carrying costs. One is currently in a dispute with a contractor over $18,000 in work that was completed incorrectly. They do not mention it at dinner. Ryan is not lying. Ryan is just the outcome you can see. The other outcomes are quieter. You file this somewhere, not consciously, but somewhere. Gap statement, age 28, path A. Estimated net equity of $38,400 in a single leveraged asset. Plus an emergency reserve tab that now has a minimum threshold and a 6-week vacancy on the permanent record. Path B. Portfolio of $24,003. Recovered liquid, requiring nothing except the continued willingness not to sell. The distance is $14,297 in favor of Path A. But the gap is not what matters here. What matters is what each system just asked of you. One asked you to sit with $31,000 on paper and not be able to touch it on the 14 days each year when you would most want to. The other asked you to watch a number fall for 7 weeks and not move a single dollar. Both systems have now been tested by something real. Both systems held. The question is what holding cost each of them. This is the first real cost. Path A, age 30. The HVAC unit in the rear unit dies on August 11th, a Tuesday. Your tenant calls at 7:43 a.m. It is 94 degrees outside and will be 97 by afternoon. You call 3 contractors. The first can come on Friday. The second is booked through the end of the month. The third can come today. $3,200 for a full replacement, parts and labor, and they take cards. You say yes. You do not have a choice that feels like a choice. Path B, age 30. Same month. The market drops 4.3% on August 11th. No specific catalyst that the analysts can agree on. Your portfolio loses $3,200 in a single session. No one calls. Nothing breaks. No contractor comes. The number changes on a screen and the day continues. Now here is the month that runs parallel. Path A, $3,200 gone because something failed. A machine that was supposed to last longer in a building that is supposed to generate income on a Tuesday morning when you had other plans. Path B, $3,200 gone because the market did what the market does, without asking, without warning, without any physical evidence that anything had changed at all. Same month, same $3,200 gone from 2 different systems. One felt like an emergency. The other felt like the weather. Neither one was permanent, but neither one was free. The asset was never the point. The asset was the environment. The fixed structure that everything else in your financial life had to fit inside. You now have 2 properties. The second, a single family in a neighborhood 2 miles east, came through a refinance at 31 that unlocked $41,000 in equity from the duplex. The math required 3 months of paperwork, 2 appraisals, and a conversation with a mortgage broker named Dale, who explained the debt-to-income calculation 4 times before it landed. The portfolio on paper looks significant. The cash in your checking account tells a different story. Your mother calls in the spring. She is not in crisis. But she could use help. A few thousand, temporary, the kind of thing families do. You open the spreadsheet. The equity column reads $94,000 across both properties. The liquid column reads $4,200. You look at these 2 numbers for a long time. You could refinance again. It would take 60 days. It would cost fees. It would increase your monthly obligation. You could sell one property. It would take 90 to 120 days. It would trigger capital gains. It would displace a tenant. You wired $2,800 from the liquid column. It leaves you with $1,400 in reserve for 2 properties that have a combined history of needing things without asking permission first. You open your spreadsheet. You find the tab labeled Emergency Reserve. Minimum $11,000. The current balance is $1,400. You do not close the tab. You add a second label next to the first, Liquidity Buffer Needed. 2 labels now. The tab stays open for the rest of the year. The buildings are still growing. The equity is real. But real is not the same as available, and available is the only kind of money that can actually move when something needs to move. The drawdown comes in the fall of the following year, not 19.3% this time. Deeper, 31.4% over 4 months. Your portfolio, which had crossed $47,000, reads $32,287 on a Wednesday in November. This is different from the first correction. The first time, you were scared of losing money. This time, you are scared of something else that you chose wrong from the beginning. That the entire logic, buy index funds, hold forever, let compounding do the work, is a story people tell because it has worked so far, and so far is doing a lot of weight-bearing in that sentence. You call Marcus, he says the right things, he has the data, he has the historical recovery charts. Everything he says is correct. You pay $180 to sit across from a fee-only financial advisor for 90 minutes. She tells you nothing you do not already know. You know this before you leave her office. You go anyway, because you need to hear it from a room, from a person, from something with weight and presence. The $180 is not for information. It is for the specific feeling of being told you are not wrong by someone whose job is to know. You do not sell. But for the first time, you understand exactly why people do. You do not sleep well that week. On Thursday night, you lie in the dark and run through the logic again, slowly, carefully, the way you would check a door you were not sure you had locked. The logic holds. It still holds on Friday. It holds through the weekend. In November, your auto invest doesn't run. Not for a dramatic reason. Your credit card expired. The new one arrived, you activated it, and you forgot to update the brokerage account. 3 weeks pass. You log in for something else and notice the $420 sitting in the queue, unexecuted. You update the card. The investment runs the following week. It is not a catastrophe. The system is not broken. But for 3 weeks, the system that was supposed to require nothing from you required something, and you weren't there. You add it to the mental ledger. Filed under, the system is not as automatic as it looks from the outside. Sandra, age 38, Path A's colleague. She owns 4 properties, has for 11 years. She's currently in the middle of a divorce. You do not ask about the details. She offers some anyway, the way people do when something has been sitting too long without air. 3 of the 4 properties are marital assets. The 4th, purchased 18 months before the marriage, titled in her name alone, is the subject of a dispute anyway. The legal fees are currently at $23,000, and the proceeding is not finished. She is not a cautionary tale. She's a person in a situation. But the situation reveals something about real estate that the return calculations don't include. Property does not sit in a brokerage account, separate and clean. Property sits in a life. It absorbs the life around it. When the life shifts, the property is there. Physical, titled, entangled. You file this somewhere, not as a warning. As a texture you now understand that you didn't before. Gap statement, age 32 Path A, equity of $94,000 across 2 leveraged properties. Liquid reserves, $1,400. 1 open spreadsheet tab with 2 labels that were not there 3 years ago. Path B, portfolio of $32,287 after a 31.4% drawdown. Recovering, liquid, and accompanied by $180 receipt for a conversation that confirmed what was already known. The distance is $61,730 in favor of Path A. The number is real, but the number is not the question anymore. The question is what kind of person each system is making you. One is an asset you manage, the other is an asset that manages you, in the best and worst sense of both. Path A knows exactly where the money is, can drive to it, can photograph it, can stand in front of it on a Sunday afternoon and feel something that a brokerage statement does not produce. Path B can wire the entire balance to a different account before lunch, can leave, can change, can respond to something unexpected without a 60-day refinance and a conversation with Dale. One costs you time on a Tuesday morning when something breaks. The other costs you sleep on a Thursday night when nothing does. Both paid. Neither got a receipt. This is where it becomes irreversible. Path A, age 33 to 35. The 3rd property closes on a Thursday in April. A triplex. 8 minutes from the duplex. You have been watching it for 14 months. The price, the rental history, the deferred maintenance schedule, the neighborhood trajectory. You know the square footage of every unit. You know the age of the water heater. You know these things because you have learned over 8 years that the work happens before the purchase. The purchase is just the moment the work becomes official. Cash flow after all 3 properties, mortgage, insurance, property tax, maintenance reserve, vacancy buffer, is $2,340 per month. Real cash flow, not the number from the back of napkin calculation you did at 25. The number after the HVAC units and the vacancy months, the roof repairs, the Dale conversations, and the spreadsheet tabs that never got closed. $2,340. It hits your account on the 3rd of every month. It does not require you to do anything on the 2nd. You call your mother on a Sunday. You do not do the math out loud. You just know that the next time she calls, the liquid column will have a different number in it. That is what 3 properties, 8 years, and 1 tab labeled liquidity buffer eventually become. But net worth on paper reads $380,000. You do not have $380,000 to spend. You have $2,340 a month and 3 addresses, and a maintenance reserve that needs to stay above $14,000, or the system starts to feel thin. Ryan calls on a Tuesday night at 10:14 p.m. You have not spoken properly in over a year. He does not open with small talk. He had been running a portfolio of 4 properties in the Phoenix market. Over-leveraged, he knows this now. He was carrying $2.1 million in debt across assets that appraised well in 2021 and appraised differently in 2023. One property sat vacant for 4 months. A second needed a foundation repair that came in at $47,000, not the $12,000 the initial inspection had suggested. He had used a HELOC on his primary residence to cover operating costs for 11 months. The total loss when the final property was sold was $210,000. He is not calling for advice. He is calling because he needs to say it to someone who will understand what the number means, not just the size of it, but the specific weight of a leveraged loss versus an unleveraged one. The way it compounds backwards, the way it reaches into accounts you thought were separate. You listen for 40 minutes. You do not say, "I told you so," because you never told him so. You said you were in a difficult position. That is different. After you hang up, you sit with the phone on the table for a while. Ryan made the same bet you made. He just made it larger and later and in a different market and without the spreadsheet tab that asked uncomfortable questions before the purchase. The bet and the system are not the same thing. You understood this in theory. Ryan's Tuesday night call made it something else. You open your spreadsheet, you look at the maintenance reserve line, you increase the minimum threshold from $14,000 to $18,500. You do not explain why in the notes column. You do not need to. The portfolio crosses $280,000 on a Wednesday morning. You are in a coffee shop in Nashville. You are here for 4 days for reasons that have nothing to do with Nashville specifically. You check the app the way you check it most mornings. The number has moved. It does so without requiring anything from you. You order a second coffee. This is the version of the story that looked impossible at 25. Not the specific number, the specific texture of it. The way a decision made at a kitchen table at 25 is still running, still compounding, still accumulating interest on interest on interest, while you sit in a city you didn't plan to be in, drinking a coffee you didn't plan to order. Marcus texts that afternoon. He has left the company you both worked at. He is starting something. He is not asking for money. He just wanted you to know. You think about Marcus more than you expected to that evening. He was the one who said don't look at it. He was right. But he also watched you almost break during that first correction and said the correct things with complete confidence. And you wonder now, sitting in Nashville, portfolio at $280,000, whether he was confident or whether he was performing with confidence because he needed to be. Whether the certainty was real or whether it was the version of certainty you construct because the alternative is not to sleep. You don't ask him. Some questions are better as questions. 2 weeks after Nashville, your college roommate calls. His name is Peter. He's getting married in Tuscany in October. 11 days. The flights and accommodation will cost $4,200. You open a spreadsheet, not the brokerage one, a separate tab. You calculate the opportunity cost of $4,200 over 25 years at a 7% average annual return. The number that comes back is $22,748. You stare at this for longer than you intend to. You close the tab, you book the flight, but you check the portfolio app twice at the airport, once at the gate, once on the jetway, in the narrow corridor between the terminal and the plane, in the specific moment when you should not be looking at anything except where you are going. You are not sure when the system stopped feeling like a tool. You do not answer the question. You board the plane. Carol is at the conference in the spring, a small gathering, 40 people, a hotel in Denver that has carpet that belongs to a different decade. She's 61. She retired at 57. She spent 32 years in index funds, automatic contributions, the same strategy you are running, scaled across a longer runway. She does not give a talk. She sits at a table during the afternoon break and answers questions from whoever sits down. You sit down. One thing she says you write down on the back of a conference schedule. The number is never the finish line. The number is just the first question. You carry it into every city after that. Gap statement, age 38. Here's what the spreadsheet doesn't capture. Path A, $380,000 in net worth held at 3 physical addresses, generating $2,340 in monthly cash flow, and cannot be accessed without a process involving lawyers, appraisers, and a minimum of 60 to 120 days. Ryan's phone call at 10:14 p.m. on a Tuesday. The maintenance reserve line went from $14,000 to $18,500 without a note explaining why. Path B, $340,000 in a portfolio that can become liquid before Friday, in any city, without a single phone call. A conference schedule with one sentence on the back of it. A question that has been traveling for 2 years without an answer. The distance is $40,000 in favor of path A. But the number has stopped being the point. One is a life organized around addresses, generating income, requiring attention, building something with physical weight, a property tax bill, and a tenant whose check arrives on the 3rd. The other is a life organized around optionality, portable, quiet, and increasingly difficult to know when it has arrived at the place it was always trying to reach. One knows exactly what it owns. The other is not sure what owning is supposed to feel like. Both are ahead of where they started. Both are carrying something the other one isn't. Neither one has fully decided what the money is for. You are 41. Saturday morning, the kind that arrives without asking. You make coffee before the building across the street has its lights on. You open the laptop at the kitchen table, the same table, different kitchen, a house you own outright in a neighborhood you chose deliberately. The spreadsheet has been open since Thursday. It is always already open. 3 addresses. You know all 3 the way you know a person. Not the person they present, but the actual person underneath. The back unit of the duplex gets cold in February, despite the new insulation. The way the triplex parking situation creates a specific tension every December when the family in Unit 2 has visitors. The gutters on the single family need to be checked after every storm because the previous owner planted a tree too close to the roofline 20 years ago, and the roots have opinions about everything downstream. You know these things because these things require knowing. The $2,340 arrives on the 3rd. It has arrived on the 3rd for 4 years without interruption, except for August 2 years ago when the tenant in Unit 1 was 31 days late and you had a conversation that both of you would prefer to forget. The system held. The relationship held, barely. The check arrived on the 4th. You open the tab labeled Liquidity Buffer Needed. It is still there. It will always be there. Not as a failure, but as an accurate description of what the system requires. You have made peace with the tab. The tab is not a problem to be solved. The tab is the cost of the structure. There is a Saturday in your memory. You are 26, kitchen table, November. First time you ran the numbers and felt the equity accumulating in silence. You were surprised that morning. You are not surprised now. But you remember the surprise clearly. The specific quality of it, the way it felt to understand for the first time that something could grow without your daily attention. That morning made you, not the equity figure. The understanding. You do not regret the system. You understand its cost more precisely than you did at 26 or 30 or 33. The cost is, this is a life organized around addresses. The addresses generate the income. The income requires the addresses. You cannot have one without the other, and you have not, for 16 years, been able to leave without arrangements. You would not trade it. But you know what you traded. Tuesday. A city you have been to twice before, once for work, once because a friend lived here for a year and then moved. The laptop opens on the coffee shop table. The portfolio screen takes 4 seconds to load. The number is there. It is larger than it was last Tuesday. It does not require anything from you today. You think about Carol's sentence. The number is never the finish line. The number is just the first question. You have been carrying this for 6 years. You have crossed thresholds, the kind that used to feel like destinations. Each time the sentence was waiting on the other side. The number moved. The question remained. You think about Peter's wedding in Tuscany. The specific afternoon light on the 3rd day, the long table outside, the kind of meal that takes 4 hours without anyone deciding it should. You check the portfolio at the airport, twice, once on the jetway, and then you did not check it for 11 days. 11 days of not knowing and not needing to know. That was the closest the system ever felt like a tool. You are not sure when the other times stopped feeling that way. The auto invest has run for 16 years. $420 became $680, became $1,100 as income grew, and the percentage held. The compounding is deep now, the kind that is difficult to intuit because the numbers involved are larger than the mental models built at 25 were designed to hold. You close the laptop. The coffee is still warm. You could book a flight before it goes cold. You are not sure, sitting here, what you intend to do with that. Both systems did what systems do. One built a life you can drive past on a Sunday and feel in your chest. The other built a life you can close on a Tuesday and reopen in a different city. You thought you were choosing an investment. You were choosing the structure your life would have to fit inside. And once you chose it, everything else had to follow. It will not feel like the most important decision of your life. That is still the part no one warns you about. Both compounded.